Top 10 Forex Indicators. According to estimates, around 96% of traders lose money and quit the market. When a trader first begins trading Forex, they are likely to encounter a variety of trading techniques. However, selecting the best strategy might be challenging. When individuals first enter this sector, they tend to overcomplicate things. New Forex traders often believe that a complicated trading strategy must be better, but the truth may differ. Trades should make things as simple as possible, since a simple trading strategy will help them respond quickly and with less stress. Forex traders must choose the most successful indicators that will help them maximize their profits. So, what is the most profitable Forex indicator? Stay tuned as we take a look at the top 10 proven winners. Hello and welcome to today's video, where we'll be looking at the best Forex indicators. Subscribe and turn on the post notification bell. Like, comment, and share. Shall we get started? Number 10. Moving Average. A trader should employ the moving average indicator since it is one of the most successful technical indicators available. Traders may use this indicator to find trading opportunities in the direction of the broader trend. If the market is heading up, you may use this indicator to detect the trend and the best moment to purchase or sell. It is a trend indicator that assists you in recognizing and tracking trends. It displays the average price over a specified period. Simply said, this indicator tracks the price of the FX market. The indicator assists in smoothing out volatility and reducing price noise. The moving average indicator aids in defining the present market trend rather than forecasting future Forex market prices. Moving averages are divided into 4 categories: exponential, linear weighted, simple, and smooth. The distinction between them is purely technical. As a result, the moving average MA indicates whether to buy or sell a currency pair. However, it will not advise you at what level to enter your trade. You will need additional technical indicators for that. 9. Moving Average Convergence Divergence (MACD). Moving Average Convergence Divergence, sometimes known as, quote, the king of oscillators, is a kind of oscillator. The indicator determines the market's driving power. It's useful for indicating when the market has had enough of advancing in one direction. The indicator based on the moving average approach is Moving Average Convergence Divergence (MACD). Oscillators are a kind of technical indicator that includes this indication. Oscillators are indicated individually in a box when they reach their maximum level. They must then fall back. The MACD indicator works best when a market has a well-defined trend or range. It is preferable to take crosses of the MACD line in the direction of the trend after the trend has been identified. Moving Average Convergence Divergence is useful for determining market trends and momentum. As a result, we may conclude that having MACD on the chart is critical. The indicator might be an important component of your trading methods and systems. Many Forex traders advise against using the MACD indicator to make trading decisions since it lags behind the price chart. However, it's still a good indicator to consider. Number 8. Relative Strength Index (RSI). The RSI, Relative Strength Index indicator, is a basic and useful oscillator. Using an oscillator like the Relative Strength Index, you can tell when the currency is overbought or oversold. RSI is one of the strongest indicators for traders who want to buy cheap and sell high. You may accept buy or sell indications when the market has no obvious direction. The RSI indicator may find optimal entry and exit prices in both range and trending markets. When the Forex market is trending, it is easier to determine which way to trade, and you should only trade in the trend's direction until the indicator has recovered from the extremes. Number 7. Bollinger Bands Indicator. This Bollinger Bands indicator may be used to determine market trading entry points and exit points. This may be used for any currency pair. The Bollinger Bands indicator is used to define price range levels in market trading. The Bollinger Bands indicator is a price ladder with upper and lower price levels that produce better trades. This Bollinger Bands indicator uses the standard deviation approach. The Bollinger Bands indicator employs 2 variables in the indicator chart to generate price levels. The names of these variables are period and standard deviation. The period refers to the period or time frames used by this Bollinger Bands indicator. Number 6. Average True Range Indicator. This Average True Range Indicator may also be used to determine market trading entry points and exit points. Any currency pair may be utilized with this Average True Range, also known as ATR. The average real range of a currency pair determines its volatility. In the Forex market, volatility assessment is crucial since it is linked to actual market activity. A rise in volatility implies a market reversal in every financial market, while a reduction in volatility indicates market continuation. The lower the ATR, the less volatile the market is, and the higher the ATR, the more volatile the market is. Consequently, if volatility is strong, you may extend your carry profit period. Conversely, reversal trade opportunities may be identified with lower volatility. Number 5. Pivot Point Indicator. Pivot points show the usual level of supply and demand for a currency pair. When the pivot point is reached, it indicates that supply and demand for the particular couple are equal. When prices rise over the pivot point, it suggests that a currency pair is very competitive. As a result, if the price falls below the pivot point, supply will be plentiful. Prices tend to move to the upper bound before making any financial market movement. Consequently, the pivot point's decrease presents a trading opportunity for this trading signal. All traders should be familiar with this Forex indicator, an important trading tool. Number 4. Relative Strength Index Indicator and Strategies. A Forex trading indicator is the Relative Strength Index. This Relative Strength Index is compatible with different trading methods and may be used with any Forex currency pairings. The Relative Strength Index, RSI, is the short name for this metric. Between 0 and 100, the Relative Strength Index fluctuates. This indication indicates where the price is most likely to reverse. When the price rises over 70 levels upward, it suggests a downward market shift. If the price goes below the 30 levels during a downtrend, it indicates a positive market turnaround. By producing a price differential, RSI, on the other hand, aids in creating investment possibilities. Number 3. Parabolic SAR. The Parabolic SAR is a price and time-based indicator which sets it apart from other indicators. Stop and reverse is the abbreviation for SAR. Essentially, the indicator will follow the trend as it evolves through time. A downtrend draws a little dot above the price, whereas in an uptrend, it draws a small drop below the price. It has the appearance of a trailing stop. The Parabolic SAR indicator may be used in several ways. Traders may use it to confirm a trend and only trade in the indicator's direction. Another approach is to utilize for trade management, trailing a stop loss to stay with the trend for a greater return to risk transaction. Number 2. Fibonacci Retracementsy. Leonardo Fibonacci, a great Italian mathematician, created the Fibonacci indicator. He built the tool to aid traders in better understanding market direction. Leonardo's golden ratio, 1.618, is usually connected with the indication. Forex traders use this ratio to identify market reversals and trading profit zones. Prices might shift 161.8% Fibonacci extension point of the current leg if prices shift with a particular trend correct in the direction of 61.8% Fibonacci reversal and suggest a market reversal according to Leonardo Fibonacci. It's also worth noting that different Fibonacci levels exist, such as 23.6%, 38.2%, 50%, 88.6%, 127%, 261.8%, and depending on market momentum and behavior. Number 1. Ichimoku Kinko Hyo. The Ichimoku Kinko Hyo, often known as the Ichimoku Cloud, is a trading strategy indicator that can execute a whole trading strategy. This single trading indicator may be used to identify several market elements. The Komu Cloud, the original Ichimoku indicator, helps traders grasp the market environment. Prices below the Komu Cloud usually suggest a negative trend, but prices above the Komu Cloud usually imply a bullish market. The Kijun Sen and the Tenkan Sen are two more important components of this indicator. Unlike the Komu Cloud, they are created using the principle of the moving average. The two lines move in lockstep with the price, and their rejection indicates an entry opportunity. It is essential to have an ideal trading plan or strategy to become a good Forex trader. Without one, we cannot expect to succeed in this market. Forex indicators are quite useful to traders today. They aid in identifying market sentiment, allowing traders to trade more successfully. Try out these that we've given you in today's video. And that will be all for this video. Was the video helpful to you? Please share with us also in the comment section how you find these indicators. Subscribe and turn on the post notification bell too. Until the next video, stay tuned and stay safe. Thank you for watching.